All right, so we got to start talking about the S&P 500 and NASDAQ 100 because next week is a very important week in the stock market. In this video, we're going to do a full market breakdown that I don't think will take too long. So let's get started and begin our analysis. Before I do that, though, I'd like to invite you guys to like and subscribe because it helps my channel so much. You guys have no idea. Now that we've done that, let's jump to what goes on Monday at 11:30 a.m., which is the emergency Fed board meeting, where they're going to discuss about advancing discount rates to be charged by the Federal Reserve Bank. What this means, guys, is that they're going to reassess whether they should continue raising interest rates or not. Now, don't panic, guys, because they actually do this on a monthly basis, and it's probably not going to be big changes to their overall decisions. They make it sound really important when they say closed board meeting and all this sort of thing, but that might just be a little bit exaggerated because, like I said, they do this on a monthly basis, and so there's probably not going to be too many big changes to their overall inflation defeating plan. Now, I would like to point something out about these interest rate hikes is that whenever Jerome Powell decides to announce that he's going to do a big rate hike, investors panic and the market goes down so much and so dramatically. But I think that this is actually good news because it is making the market more accepting, and it's like pruning a plant. When a plant is pruned, it can grow better than before. And this is exactly what is happening right now. So in the long term, we're going to see the market start climbing back up stronger than ever before because now we are reaching a sustainability level in the economy. We're getting to a place where we can consolidate and start building back up. So don't forget about the big picture, guys. We are buying this dip because it is an opportunity, not a trap. Bear markets don't last forever. So don't forget that, guys, as we continue along this week and continue seeing low prices in the stock market. So guys, let's jump to the NASDAQ 100 ETF to analyze different price levels that I'm looking at and determine what price I like buying at based on the support and resistance lines. So as you guys probably know, the NASDAQ just broke a 52-week low, just like the S&P 500 did on Friday. There is a lot of support at the current prices because the NASDAQ just broke $11,000 and the S&P 500 just broke $360, which is very, very strong support there. And I was honestly surprised at the dramatic drop there at the end of the day on Friday. But there is even stronger support for the S&P 500 at $350 per share, and in the NASDAQ, that's $10,600 per share. By the end of the year, I also suspect that the S&P 500 will probably not be able to break $340 per share and the equivalent of $10,000 per share in the NASDAQ, just because that is such a strong area of support that I believe that the market will be very, very tempted to bounce up from such a low price. In other words, guys, don't allow yourself to miss out the opportunity of buying these ETFs if they continue falling that low, because that is a very, very good discount price right there. And of course, guys, that also means that the dividend yield starts climbing up as well. In the S&P 500, the dividend yield is now 1.5%, which I think really helps to add to the incentive of buying this ETF at such a discount price. So now we're going to look at the really short-term graph. So since the NASDAQ 100 and S&P 500 ETF broke its 52-week low, I believe that on Monday the market will not continue falling quickly at the open, but rather it might be more volatile at 11:30 when investors start speculating what is going on at that closed Fed meeting. But of course, guys, it is a closed Fed meeting, which means that we might not know what's going on there until afterwards. So there might not even be all that much volatility at that point either. The point that I'm trying to bring here, guys, is that the market did just reach a 52-week low, which means that we might see more pressure in moving upwards rather than downwards. So guys, now that we've discussed this, I'd like to fulfill my promise to my subscribers to look at Disney stock because this is a very interesting company right now. It just broke $95 a share, which means that it is starting to be at the lowest price that it has been in 5 years. Well, what can we say about their actual statistics? Let's take a look. So their quarterly revenue growth is 26.3%, and their quarterly earnings growth year over year is 53.5%. What this means, guys, is that the management is working on improving their numbers. They're working on making their stock a more attractive purchase for investors. Yeah, they might not have the most impressive operating margin, profit margins at 3%, 8%. Those aren't amazing numbers. But what is amazing is their growth and how quickly they're working on fixing that. Another thing I'd like to point out is that even though they have more debt than they have cash, they do have a lot of revenue at $81.1 billion, and that is going to help cover that difference very quickly, which means that Disney will be rising back from the dip that they're in. And guys, another thing to keep in mind is that Disney is a household name. It has been around for many, many generations, inspiring people all over the world. I am quite convinced that this is a good long-term play here at $95 a share, which, by the way, is the price that I personally bought it at. But I do believe that there could be more volatility in the macro, which could shake it down to $90 per share, which would mean a new 52-week low, an even better purchase. So guys, let me know what you think of my analysis here, and don't forget to like and subscribe to the channel. Thank you so much, guys. Have a great rest of your day, and good luck in the markets.